so that he can watch later on. So if you don't want your voice on YouTube, maybe keep it quiet today, because that's what this is. I'm not a cyborg. This is a microphone. And all right, I've got homework 8. Just as a reminder, the final exam is 1 week from today, and you can bring 2 equation sheets for that exam. So, you know, in the midterm exam, you were able to bring 1 equation sheet, and since we've covered, you know, twice as much material now, you can bring a second equation sheet. I will mention that the material we've covered since the first half of the class is going to be emphasized on the midterm exam, although just due to the nature of the material, you can't really have a non-comprehensive final in this course. But any questions that are related to the first half of the class, probably I would ask a little bit less complicated questions. And so, you know, it's my intention to really focus the points and the intensity of the exam on the stuff we've covered since the first half of the course. So if you have any questions about course material, I'll be in my office for much of next week, and I don't remember if I have any exams interfering with my office hours, but I don't think so. So, you know, I'll be available at my normal office hours, or you can shoot me an email about the final. Any questions? It'll be 2 sections. There will be a conceptual section of the exam, and then there will be a problem-solving section of the exam. So I'll be asking both types of questions on the final, just like I did with the midterm. Okay, so we're going to talk about depreciation and taxes today, Chapter 7 in the book. We won't have a homework assignment covering depreciation and taxes, but the in-class exercise that we're going to work on today does give you a chance to get your hands dirty and calculate some numbers along with the examples that we're going to be doing. Before we get into that, you know, we don't have a whole day set aside for exam review, and so what I thought I'd do is I'd give you a couple of concept questions. These are of the sort that could show up on the exam. You know, this is just to give you a sense for what sort of concepts you need to remember. This isn't an all-inclusive list of the concepts you need to know, but would you be able to answer a conceptual question if I asked you to explain in your own words what the repeatability assumption is and when is it used? Okay? So the repeatability assumption, remember, is the idea that if you have 2 different alternatives with a different length time, like a different lifespan, the repeatability assumption is used to compare alternatives that have a different life length, and you would find the duration that is common to the both of them, so that if one item lasts 3 years and the other lasts 4, you'd do a cycle of 12 years in total, and you'd repeat the 4-year cycle 3 times and the 3-year cycle 4 times. The assumption says that you can acquire the item for the same cost and that it generates the same return each time you repeat it. So that's the sort of information I'd hope you'd summarize in a description of the repeatability assumption. You've already had a question on a previous quiz of if the repeatability assumption doesn't apply, how can you compare projects with different useful lives? So that would be a good thing to review from the notes from the textbook. What about this? Thinking back a little bit further, do you remember the differences between ERR and IRR? And so what is the main advantage of the external rate of return? It's more complicated, a thing to calculate, but what's the advantage? Tony, do you remember that one? How is ERR more complicated? I said it's more complicated to calculate than IRR. What's the catch with external rate of return? Okay, that's right. Christian remembered that the assumption in the internal rate of return is that all the money that gets generated is reinvested in the project, and then that reinvested money also generates returns at the same rate that it was originally generated. So in other words, that's saying if you had a bank account and you're earning interest, the interest goes back into the bank account and the interest itself earns additional interest. That is built into the internal rate of return assumption. But not every project is able to generate, you can't always reinvest your earnings back into the same project. And so the external rate of return, the advantage there is it allows you to invest the return at a different rate. So the interest could be reinvested somewhere else. So the advantage is it's more realistic because of that. What is a self-liquidating project? That's the type of project that can pay for itself. And the other kind of project is a multi-purpose project, one that doesn't necessarily pay for itself because it has more costs. Maybe just the salvage value would be the only positive cash flow in a multi-purpose project. Here's a hard one. What B to C ratio gives you the thumbs up? 1, yeah, okay. Excellent, all right. I like the enthusiasm. But what's a shortcoming with the B to C method? Now this would be a short answer question. We talked about, after introducing the conventional and modified methods for solving B to C ratio, what's the drawback or weakness of using this for decision making? Okay, what do you mean by that?
Like when you do the comparisons afterwards, sometimes it can be better than what might not necessarily be the highest.
Okay. Oh, okay. So, yeah, good. What he's referring to is that you don't necessarily know if it'll tell you yes or no on a single project, but it doesn't tell you which project is best. And so to know which project is best, you should do the incremental B to C ratio method. Okay, very good. Another shortcoming of the B to C method is that too often that analysis is applied after the fact. It's not used for decision making, but rather it's used for justifying a decision that's already been made. Or another shortcoming of it is it's really hard to know what interest rate to select. Remember that the interest rate basically governs the accuracy of the analysis, and so for a public project where the government is using money that they maybe didn't borrow, you can't just use the interest rate that you borrowed the money at for this project because maybe it was tax revenue. And so knowing what interest rate to use is one of the shortcomings, is that it's really subject to manipulation. And along those same lines, it's hard to translate some of the benefits or some of the costs into dollars. Remember the ugliness of the Huntington flood wall? What's the cost of that? That's a disbenefit, but how do we assign a dollar value to a disbenefit like visual distractions or the disbenefit of additional noise from airplanes flying overhead? Okay, so now into the new material. Depreciation is the first thing that we're going to talk about today, and it's important for you to understand what depreciation means, the textbook definition of depreciation. And it just basically means that property has a decline in its value over time. And I've got a picture of two cars here on screen. Well, it's the same car, just different years. Honda Civic. And here we've got a really old Honda Civic. I think they first started making the Honda Civic in the late 70s. And here's a newer model Honda Civic. And obviously these two cars aren't going to have the same value. And sometimes you hear about, as soon as you drive a car off the dealer's lot, it's already lost 10% of its value in that first mile that you drive it. Just because now it's used and it's not new anymore. And so over time, equipment loses value. And in a business sense, actually, that's an awesome thing. It's really great. You love the fact that your equipment is losing value. And I'm not being sarcastic. It's actually a good thing that business owners want to maximize the depreciation of their equipment. We'll talk about that. When you just bought a shiny new car, you're not in love with it. But business owners like depreciation. So we'll talk about why that is. Well, here it is. The reason why is that it's because the depreciation, you can deduct that against your revenue, and so it reduces the amount of taxes that you owe. So if you've made an investment, you buy a piece of equipment, and the equipment is losing value, then how much value the equipment lost in a given year you can deduct that from your revenue and you don't have to pay taxes on it. So if your taxes, if you made $10,000, if your business made $10,000 in a year, and you were able to calculate that your equipment had a depreciation of $3,000 during that same year, then that would mean that the taxable revenue is only $7,000. And so it's a deduction against your taxes. And so when we're calculating depreciation, we go through these calculation procedures starting with B, the cost basis. And that means the initial price that you paid for it plus how much it costs to put it into service. That might be the shipping costs to get it into the location. It could also be the installation that's required in order to get it operational. Now the book value is how much it is worth at any given time. So at time 0, when you first buy it, the basis and the book value are the same. But then over time, the book value gets lower and lower. And so I'm sure everybody here has heard of the Kelley Blue Book. You know, when you're thinking about getting a used car or trying to find out how much your used car is worth as a trade-in, you'll go to the Kelley Blue Book, or there are several competitors to it. And you can look up based on the mileage or what year it is and the condition. Those are the 3 factors they usually ask you to put in, also along with, like, has it got nice wheels and a moonroof and, AM/FM cassette, all that stuff. So you put in you let it know what's the condition of it, and then it tells you how much it's worth at any given time. So businesses don't go through that same process. They don't say how many miles is on the car. They don't necessarily say whether it's got certain features. There's a kind of a more standardized approach that's used for determining how much depreciation occurred during a year. We're going to go through several of those methods. There are some historical methods that you can nowadays use just mostly for estimation, but then there are more standardized approaches that we're going to learn as well. So not everything can be depreciated, though. I said it's this really great thing that businesses are anxious to have depreciation because it counts against their income taxes. Well, you couldn't get depreciation on a meal. You can't go to a restaurant, buy a meal, and say, well, this meal was worth $20 when I paid for it, but now that I've eaten it, it's not worth anything anymore. So, it's not considered a depreciable expense, the food. One of the criteria for it to be depreciable is that it has to be held to produce income. And so your house, you live in that. That's not going to be generating income. You can't depreciate the house that you live in. It must have a determinable useful life, longer than a year. And so that excludes a lot of consumables like gasoline, food, and the like. It also has to be something that wears out, decays, gets used up. So if your business bought diamonds as an investment, diamonds don't wear out. Even if you're intending to produce income with it, if you're going to try and sell it at a profit, you still can't use diamonds as depreciation because it's your inventory and it doesn't wear out and it doesn't have a certain useful life. So really these are the criteria that the government used to sort of hone in on the idea that it's supposed to just be for your equipment that you use for your business. Maybe it's an asphalt roller or a paving machine, or vehicles are depreciable. Computer equipment is depreciable. We've got a long list of depreciable items that we'll take a look at it a little bit. And also, they estimate in this list how long that equipment generally lasts. So again, why does a business want their equipment to depreciate? Tax deduction. Very good. Nobody likes paying taxes. And it's illegal to evade your taxes, but it's not illegal to avoid taxes. And the difference between tax evasion is like lying about your income or getting profits and hiding the profits. That's tax evasion. But tax avoidance is organizing your affairs so that you have to pay as little as possible in taxes. And so tax avoidance is something you should do. You don't want to pay more taxes than you have to. And in fact, if you're a business owner and you've got partners or shareholders, then it's your duty to avoid taxes. And there are some companies that are amazingly effective at doing that. And I think one of the classics is General Electric, a big international corporation, and they pay hardly anything in taxes. They organize their assets all over the globe, and Apple is another one that hardly pays any taxes to anyone worldwide because they legally shift things around that they avoid taxes. So before 1981, when this standardized approach was put into place, there were a couple of approaches that were used to estimate the depreciation, one called straight line and one declining balance. And we'll do an illustration of those just to show you how it works. But after 1986, the general depreciation system was put into play. And so now the calculation of it is a lot more simple than it used to be. Here's how the other terms you need to be acquainted with so you can do calculations. There's, of course, salvage value, and the little n here means at year n when the equipment is actually going to be sold. And so the market value and salvage value we've sometimes used interchangeably, but the way that they're distinguished between here is in salvage value it's just if the equipment is totally going to be junked out and sold for scrap, melted down. But market value maybe means that it has a value above the salvage value at any particular time. You can calculate the market value on an item even before it's salvaged. Depreciation is how, in year K, is how much of the depreciation occurred in any given year, and then DK prime with a star here is just how much total depreciation has occurred up until the year of interest. The straight line method says that every year you're going to have the same amount of depreciation. So here are the formulas for the straight line method, and the formulas maybe make it look a little bit more complicated than it actually is. Basically, this formula for the depreciation in a certain year says that you find the difference between the book value and the salvage value. So how much you paid originally minus how much you're going to sell it for when it gets melted down for scrap. The difference between the two divided by the number of years. So every year is going to have the same amount of depreciation. The cumulative depreciation as the number of years that have occurred multiplied by the depreciation in each year. And then the book value is the original purchase price minus the cumulative depreciation. So to make sense of this, let's just take a look at this little example. Let's say if we spent $4,000 on a saw, and it has a useful life of 10 years. So the salvage value at the end of 10 years is 0. So we're going to, obviously in this case, if it's $4,000 that got paid originally, and it's going to depreciate over 10 years, then that means each year there's going to be a depreciation of 4,000 divided by 10. And so each year we're going to have $400 of depreciation. So if we wanted to put together a table of annual depreciation and book value, it would look like this. In year 0 is when we buy the item, and it has a book value of 4,000 because that's how much we paid to get it into service. At the end of year, EOY means end of year 1, the depreciation that happened during that year is 400. The cumulative depreciation, so all the years up until now, is 400. Which means the book value is 3,600. End of year 2. So you can see the depreciation every year is always be 4,000. The cumulative depreciation is gradually going up until it reaches 4,000. And the book value is gradually declining until it gets to the 0, which is the salvage value that's defined in the problem. So it's very simple, the straight line method. But it's not realistic. Because we know that, for example, I used to drive a Dodge Intrepid. And the Dodge Intrepid doesn't lose the same amount of value every year. The Dodge Intrepid lost a lot at first, but then it gradually started stabilizing. If we could say that this is the value, and this is time. Why do you think that a vehicle loses more of its value in the early years than later on. Tony, any thoughts on that?
Wear and tear, maintenance.
Okay. Yeah. You know, the niceness of it wears off, but then in the end, you know, it still drives, so it's sort of the value stabilizes.
You're going to hit a point where mileage doesn't matter.
Right, yeah. You're going to get to the point where, you know, people are a lot less, you know, the value of a car, once it's been driven 50,000 miles, you know, that's a big drop from 0 to 50,000 miles. But what about when it's 200,000 miles versus 250,000 miles? Well, they're both junky cars. So there's not really a lot of difference between a car with 200,000 and 250,000. So the straight line method is a little bit unrealistic, which is why there's this declining balance method. The declining balance method tries to simulate this curve that there's a lot of depreciation up front, but then eventually the depreciation decreases each year. So here are the formulas for it. We have the same things we're solving for. We're finding the depreciation in any given year, the cumulative depreciation up until this time, and then the book value in a given year. And this book value N is the book value at the end of the series. Now, there can be multiple curves though, like maybe it declines like this, maybe it declines even more steeply. And so the slope of that line is sort of defined by this factor R. And it's a constant percentage of the asset that's lost each year rather than a constant amount. And so here's an illustration. Let's say that we're going to do a 200% declining balance. So if we have 200% declining balance, what that means is that we want to have 0.2 as our R value. And so if it was $4,000 was the initial upfront cost, then the depreciation in year one was $800. So we lost basically 20% of that previous book value during the first year. So you see the cumulative depreciation is 800, which means the book value at the end of the first year is 3,200. So now what's 20% of 3,200? That's where this comes from. This 640 is 20% of 3,200. So this is how much depreciation happened in the second year. The cumulative depreciation is the 800 the year before it, and then the 640. So that's where 1440 comes from. And then you get this number by subtracting the initial value, 4,000, minus the cumulative depreciation. Or the previous year's 3,200, subtract the 640 depreciation that happened that year. So it keeps going and going, but what you'll notice is that it never quite reaches zero, because each year you're just losing 20% of the remaining value. So in the end of 10 years, this got down to $429 because it only lost 20% of the previous value being $536. So that's an illustration of the declining balance method. Okay, since we're pressed for time, we're going to skip over this example because I want us to have plenty of time to talk about taxes and then get into the in-class exercise. So we won't actually go through the straight line and declining balance method example. What's more relevant, because this is the system that's governing today, is the GDS method. And in the GDS method, you basically look up what class of or category the equipment that needs to be depreciated falls into. And there's a table in your book, and we'll look at the table here in a minute, that it classifies equipment according to certain categories, and then based on what category it's in, it tells you both how long that item is going to last and then also how much depreciation happens each year of its life. And so that doesn't mean you have to throw it out at the end of the depreciation scale. You know, this scale may say that computer equipment lasts for 5 years. Well, that's just their estimate. That's how they're basing the depreciation on. Maybe you're going to replace it after 2 years, and even though you've thrown it away, you're still depreciating it because that's what the federal scale says. And in some cases, the equipment may last far longer than you're officially able to depreciate it for. But this schedule just sort of standardizes it so that it's, the system is less subject to abuse. But one weird thing about it is that they don't want to let you take a lot of the value the first year that you buy it, because some people are going to buy an item on January 1st, some people are going to buy an item on December 31st, and the federal government didn't want people to have the same amount of depreciation based on, if they bought it towards the end of the year. So the way they sort of got around that was they only have half the first year's depreciation in the first year. And that seems weird, but I'll show you a table that illustrates that point in just a minute. But here's a table that shows the different categories, different equipment categories, and how long they estimate things will last. This is table 7.2 from the book. And so it says, for example, equipment that's used in construction. It has a class life, construction equipment, of 6 years, but if you go according to the GDS schedule, which is what we'll use, it's 6 years that it is depreciated over. So they estimate that it'll last 6 years, but you depreciate it over 5. Equipment that is used for manufacturing cement, they estimate will last for 20 years, but you actually get to depreciate it over 15, and so on. You get an idea. You just find out which category this equipment belongs to, and then look this up, this GDS recovery period up, and then multiply the original book value by these factors, and that tells you how much depreciation you get to take. So that $4,000 saw, we would say it's used for the manufacture of wood products, maybe, if that was a saw for making wood, like planking or something. Okay, so it'd have a GDS of 7. We go to the column, the 7-year GDS, and that $4,000 saw, you'd multiply 4,000 by 0.1429, and that would tell you how much you get to depreciate in year 1. And then in year 2, you multiply that original purchase price by the factor, and that tells you the amount of depreciation for that year. Now, the weird thing I was mentioning, where they only give you half of the depreciation in the first year, you'll notice that, for example, here in the 5-year column, in the first year they're only giving you 20% of the item's depreciation in the first year, and then in the second year you actually get to depreciate even more than that. And it's not because they think that it's actually wearing out more in the second year than it was in the first, but it's just going back to their uncertainty of when you actually bought the item. So, okay, so since this is more relevant, we'll actually work through this example here. We've got a computer system that was purchased for $20,000, and an additional $2,000 was spent getting the equipment installed and put into service. At the end of the estimated salvage value is $4,000. We'll use the GDS system here to go through and find out how much the depreciation should be. All right, so actually, do I have this on a table? Oh, okay. The computer equipment, if we go here to this table, you look through computer information systems, including computers. And so as a GDS recovery period of 5 years. And so we'd go to the 5-year schedule, and it's hard to see there, but I'll write it down. 1, 2, 3, 4, 5, 6. And that's the weird thing, that the 5-year recovery period actually has 6 years of depreciation listed, because they give you half an allotment in the first year. So 0.20, 0.32, 0.192, 0.1152, 0.1152, 0.0576. Okay. So if we have a cost basis of $22,000 originally, $22,000, then the depreciation for any given year is simply going to be this original cost basis times the amount that's shown from the table. So you can see that we had an original book value of the $22,000, and according to GDS, even though we know from experience that the salvage is supposed to be this $4,000, that's the real world salvage value of it, it doesn't matter. We still get to depreciate the whole amount because that's what the table says, is that it depreciates all the way to zero. And so here are those factors that we get out of the recovery table. You multiply the factor by the book value, and then you have a gradually declining book value all the way to zero at the end of 6 years. All right. Let's talk about income taxes now. As you learned from your personal economic analysis, the amount of money that you can save and spend is greatly reduced by both state and federal income taxes. And income taxes actually are a relatively recent invention. Does anybody know when income taxes were first put into place? During the Civil War. And it was supposed to be temporary. Income taxes, they said, well, we're just going to set up an income tax to help pay for the war. Well, of course, taxes are never temporary, right? But it was 5%, and people went crazy at the idea of having to pay 5% income tax. And of course, now the terminal rate is much higher than 5%. We'll look at a chart that shows what I mean by terminal rate. But depreciation and income taxes are related because income taxes are reduced by however much you're able to depreciate out of your revenues. There are a couple of terms, BTCF, before tax cash flow, and after tax cash flow. And we could make a cash flow diagram that shows the revenues for each year, ignoring taxes, but what's more important when you're actually evaluating a project is you have to find out what your profits are going to be each year. And so the difference between your revenues and the taxes you'll have to pay can help determine what the profits are. And so when you're discounting future amounts to the present to try and decide whether you should do a project, an important thing to keep in mind is the taxes that are going to have to be paid. And there's a lot of different taxes out there. There's the income taxes, which you're probably just becoming acquainted with. I remember it was in college that I had to fill out my first tax return, and my parents were still claiming me on their taxes, and so I didn't even get the standard deduction for myself. So I had to all of a sudden come up with like an extra $400 I wasn't ready for, and it was a rude awakening to what has continued to be a really unpleasant subject all through your life, income taxes. So here in Huntington, we don't have a local income tax. There's a, what do they call it, a user's fee of, I think, around maybe $6.50 a week that you have to pay for the privilege of working in Huntington. But some localities actually levy an income tax as well. The little town that I used to work at in Ohio had a 1% local income tax on top of the roughly 5 to 6% state tax on top of the roughly, in my tax bracket, 27% federal tax. There are property taxes that you have to pay on buildings that you own and land that you own. And here in West Virginia, we also pay property taxes on our vehicles. Each year, the Cabell County assessor sends out a property tax notice to everyone who lives in the county that owns property, and they want you to pay taxes on boats, anything that has like a tangible, accessible value. And in fact, on that same form, they ask you to tell them how many goats you have. And I always sort of get a chuckle every year when I tell them I don't have any goats. And I think they charge you $2 a goat as your property tax. There's also excise taxes, and excise taxes are special items that are taxed even more over and above ordinary things. And so gasoline is an example of something that has a special excise tax. And if you go to some pumps, they have a little sticker on the pump that tells you how much the federal and the state taxes are. And it varies from state to state, but I think here in West Virginia it's around 46 cents that we pay on special on fuel. Cigarettes, alcohol are items that sometimes also have additional excise taxes on them. And then of course there's sales taxes, and everybody's acquainted with what those are. So if you want to calculate the after-tax MAR, the relationship between the before-tax MAR and the after-tax MAR is that your after-tax MAR is going to be the before-tax MAR multiplied by 1 minus t, where t is your tax rate. And so you can convert between the two according to that formula. And like I mentioned previously, that your taxable income is the gross income minus expenses and depreciation. So your expenses might be if your business is selling ice cream, then it would be all the materials you use to make the ice cream, the employees' wages, and then you also get to depreciate, reduce the amount of taxable income by the depreciation. Before-tax MAR. Is before-tax MAR greater or less than the after-tax MAR? And this is a little bit confusing. What it basically comes down to is that if you're taking taxes into account, then you have to have a higher rate of return than you otherwise would. So let's say that if your before-tax MAR is 10%, if you want to earn 10%, then really what you have to do is you have to set a MAR higher than that to account for the amount that's going to be lost to taxes. Okay, here is a table that shows how to calculate your federal income tax. And so the first $50,000 of income, these are the corporate tax rates, not the personal tax rates, although personal taxes are sort of calculated in a similar way. The first $50,000 of taxable income is taxed at 15%. And then once you make more than $50,000, then your tax rate goes to 25% on the additional dollars. It's not that you have to pay 25% on everything that you've made. It's just the money that you made between $50,000 and $75,000, that incremental amount is taxed at 25%. And so the $7,500 is 15% of $50,000. So let's say, for example, that you made $65,000. So if you made $65,000 as a business, then your tax would be $7,500 plus 25% of $15,000, because $15,000 is the amount between $65,000, which is the amount you've earned, and $50,000, which is the cutoff starting at the next tax bracket. So it goes on and on. So the tax rate continues to increase until you get up to $335,000, but then the tax rate goes down to 34% and then up again. So it's a little bit weird how it goes up, and then down again. But that's Congress for you. They're the ones who set the income tax rates. This marginal income tax increasing is a way of saying that people and businesses who are more successful end up paying a larger share of the taxes because the income tax rate is increasing. Okay, so let's take a look at an example of how calculating taxes goes. If a company has gross income of $5.27 million, and then their expenses are $2,927,500, and then they had depreciation that totaled $1.87 million. Then what is their taxable income and the federal income tax liability? Okay, so in this example, if you want to calculate their taxable income, you start off with their gross income, subtract the expenses, and subtract the depreciation. So their taxable income is $468,200. Now their income taxes, you calculate $468,200. Let's go back to that table. So they are in this range at $400 something thousand dollars. And so their income tax is going to be $113,900 plus 34% of the amount over $335. So we need to find the difference between what their taxable income is down to $335, and the difference between those two numbers is taxed at 34%. And that's what this is showing, is it's the $113,900 plus 34% of the additional amount over and above $335,000. So the total there is $159,188. Or the other way to illustrate it is that the taxes are 15% of the first $50,000, then 25% of the next $25,000, then 34% of the next $25,000. So this is just showing each of the steps rather than starting off with the lump amount, this lump amount of $113,900. This is the increment of each of those lump amounts. Any question about taxes? Not every country has taxes, income taxes. I lived over in the Middle East for a couple of years, and there was no income taxes in the UAE. It was great. That's a good question. I think, no, Florida does have income tax, I think, but it's a relatively low rate. Texas, yeah. But then on the other hand, I think Texas has higher property tax. It's really high, yeah. And there are some states that have no sales tax, like Oregon, I believe, has no sales tax, and maybe Delaware. Yeah, Delaware also. I was reading an article that said that the most profitable Apple store in America is in Delaware, because people go to Delaware so that they don't have to pay sales tax on their phones and their iPads and everything. So here's a graph that shows the tax rate as a function of your income. So it's just showing, if this is a steep curve, then that means you're getting taxed a lot. So it starts off relatively mild slope here, but then it gets steeper the higher your income, but then it starts to taper off again. Okay, so I have an in-class exercise. Now this is related to applying the depreciation stuff that we've talked about today. And I'd like you to calculate both the straight line, the declining balance method, and then, also do the GDS method to find out how the depreciation varies over time, and then on Excel make a sketch of the book value over time for all three methods. And so actually this is a problem that probably is best solved using Excel. As I usually do, I'll put the solution to it up on screen so that as you're working on it, you can check on your work and see how it's going. So here's the solution on screen there. So basically what you're going to be calculating is just with the straight line method, that's the one where it's the same amount gets deducted each year from the book value. And the book value will go from the original amount that you paid, and it'll finally finish at salvage value that's specified in the problem statement here, that $2,500. Now the declining balance method, it doesn't go down to exactly the salvage value. In the declining balance method here, since it's a 200% declining balance, that means that each year you're losing 20% of the initial amount that was that was there. And so you can see it's going down gradually, and it terminates at $2,600. And then the GDS is the simplest of the three. That's where you just look up off the table and then multiply that table depreciation fraction by the original book value.